Alright guys, welcome back to the channel. Behind me is a historical chart of the financial markets, and in this video I'm going to be sharing you my thoughts on the next big crash, what's happened in the past, what's likely to happen next, when it's likely to happen, and most importantly of all, what you can do to take advantage of the huge opportunities out there at the moment. In this particular lesson, you're going to learn more in such a short space of time than you would spending years on YouTube or spending thousands of pounds. And by the end of this video, my goal is for you to walk away armed with some new powerful knowledge that you can apply to your wealth creation journey. So let's get stuck in. All right, so what I want to share with you specifically in this video is some trends, some warning signs, some predictions, and also things that you might want to consider in order to spot opportunity and be able to make the most of the opportunity. I want to share with you on exactly how the market balances out so that you can identify for yourself what is happening and know how to approach your own investments. So first of all, Warren Buffett famously said, you want to be fearful when others are greedy and greedy when others are fearful. Now, what does that mean? Well, let me ask you, do you think people are being greedy right now or fearful? What have you seen going on in the markets? What have you seen the behavior? And I want you to kind of have that in the back of your mind while you watch the rest of this video. Understand that a major crash happens every 10 years on average. It's been 11 years since we recovered from the global financial crash, and that took the plunge. But over the last 93.5 years, there have been 9 crashes. So if you hit the like button now, I'm going to teach you more in the next 10 minutes than you've ever learned about the markets in such a short space of time ever. Go on, do it. All right, so look, back in 1929, we had the Great Depression. And that crash, which was a bit of the anomaly of all of the crashes because it lasted the longest, it lasted around 24 years from the start of the crash to the full recovery of the crash. But since then, we've had many more. And what I want to first point out is what was going on beforehand, so you can get your head around the reasoning and why it happened, so that you can start to see the patterns. So I'm not going to go right back into that. I'm not going to go right back into the 60s and talk about the flash crash and the go-go years where the Dow Jones hit a record high, because I think most of the people watching this channel will be roughly in the age of 20, 25 to 50, 55, which means you're probably too young to remember what was going on around that stage, and they're all going to be relevant anyway. So I'm going to start where you may remember, which would be the 70s, the early 70s. There was the oil crisis, or the oil embargo, where basically 12 members or countries that made up the OPEC agreed to stop exporting oil to the US, and the price of oil, of course, more than quadrupled. Gas prices went through the roof. People got greedy, and at the same time the value of the dollar dropped, which really hurt the OPEC countries, and at the same time the interest rates were being adjusted. So many of the businesses, the startup businesses and smaller businesses, didn't know whether they were coming or going. They collapsed, lots of jobs were lost, less spending. That weakened the consumer confidence, which I'll talk about in a minute, but it was a recipe for a correction, okay? And then in 1982, the Fed hiked the interest rates to 21.5%, and that was going on in the background in the 80s while everyone was in boiler room mode.
Will not hang up the phone until their client either buys or dies!
And sales mode and TV commercials and businesses and electronics and Wall Street traders, they were all having it off. But in the background, there was a hefty tax bill introduced, there were tax benefits being reduced, there were high trade deficit figures having a negative impact. So whilst everything looked great on the outside, and there was a huge 5 or 6 year bull run since 1982 interest rate hike, a massive correction was due in the 80s to humble the market. And then in October 1987, the stock market crashed more than 20% in one day.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points. The day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
And I want you to remember that, because I'm going to share with you something in a minute that's going to be mind-blowing on that. But on top of all that, greedy, computerized trading had come into play, and Wall Street fat cats were able to close positions quicker than ever before, which had a bit of a domino effect on the crash, and it also played into the crash. Then in 2001, we saw the crash of the dot-com bubble. This was the Dogecoin of the day, right? Again, everyone thinking nothing can go wrong, intelligent people buying up Yahoo and every tech stock that they could get their hands on.
I had bought stock in Sun, Selectron, Yahoo. You know, I'd done my research. I didn't think I was stupid.
thinking that there would be no end, and greed and greed and greed and FOMO. But what a market is something that it's truly worth, what people are willing to pay. So sooner or later, the bubble has to end. And just like Bitcoin in 2017, we saw the tech bubble get humbled and crash. After rising 400% in 5 years, it fell over 46% from the previous high to the bottom, to the low, and people got bitten. And of course, when people get bitten, fear sets in. And fear sets in just as the prices drop to bargain prices. Then the last one, the last crash before this video, before COVID-19, was the global financial crash. It caused by greed and banks lending more mortgages than people could afford to repay. So they wanted to give out more products so they could fund their hedge trading. And they created all these interest-only loans that all of a sudden could become accessible to everyone, subprime borrowers. And then the interest rate went up. And then house prices went down. People couldn't afford the repayments on their houses, but at the same time they couldn't sell their houses. Then banks stopped lending to each other and boom, the market gets humbled again. Fear-driven people stop spending. They need to build up confidence. People got burned, so they don't want to spend any money in fear, even though the prices are so low. And then that leads us to this most recent pandemic and what we saw in 2020. And before I get into that, I just want to explain the warning signs here. Let me first say that if you study these crashes and recessions, you'll notice that one, they happen every decade. Two, they've already started due to over-exaggeration or inflated euphoria before we officially announce the crash. The market is only officially in a crash when we decline 20% from the previous high. So in March 2020, you saw on the news that we were officially in a recession, even though the high of the market was back in January. So it took 3 months for the masses to be told that there was a recession, when in fact that was too late. Now look at this chart here. This is the last 50 odd years or so of the top 500 performing companies in the USA, the biggest companies on the planet. And this graph, to me, represents human evolution, okay? And in this graph, you'll see the crashes I mentioned. If you study these, you'll know how long each one lasts, how long the recovery period is, what the percentage decline is, what the total elapsed time is of the entire crash from start to finish, and you'll see some very interesting stats. Not only does this give you a foresight as an investor, but it keeps you calm. It prepares you to be greedy when others are fearful, and fearful when, or cautious when others are greedy. And most importantly of all, it allows you to see some really, really important patterns that show you where the market is due to be humbled and where it's likely to pull back to over time. And what's more, if you're regularly buying these companies, it can give you a huge advantage over when to add more money and when to reduce your deposits, so that when you come out of a recession, you're already well in profit instead of sitting on your hands for 3 years and riding it out like some of these financial advisors are telling you to do. But anyway, look, if you look closely here, you'll see some of the crashes that I just mentioned. And what you'll notice about the patterns here is that there's a saying in the markets that the bulls take the stairs and the bears jump out of the window. And what this is referring to is human psychology. Remember, we're talking about fear and greed, and we're more fearful than we are greedy. If we came out of our houses and walked 50 yards down the road and we wanted to get some food because we were hungry, but we saw a lion, we would run back to the house to avoid the lion before eventually coming out of the house to get some shopping and get some food. We'd have to gain some confidence to eat. We might wait there for an hour or 2 hours or even a day or so. Now, remember I said this is a graphical representation of human evolution? Well, it is. And it's also a graphical representation of mass human psychology. So look at the crashes. The fear sets in, we jump out of the window. The recovery period is slow and steady as we gain confidence. This is what consumer confidence is. This is also why they have stimulus checks to stimulate spending, to bring out confidence in people. And it takes a while. And look, you can see it here, and again here. In all of the crashes that I've mentioned over and over and over again, the bulls take the stairs and the bears jump out the window. We are more fearful than we are greedy. Now, look at this most recent crash. With all that said, look at the average duration of all the crashes in the last 93 years. It's about 4.7 years. And what's more, in each of those crashes, you see the bulls taking the stairs and the bears jumping out the window. But look here, look at this most recent crash. We've got a V-shape, pretty much a straight V-shape, a 3-month recovery period. And not only a recovery, we have a new high. A new market high. Never before has that happened in history of crashes. So let's take a look at why that might be. And I want you guys to think about what could be artificial about this move and what could be lurking underneath, as well as what's going on right now that could give you signs to be fearful or cautious while everyone else is being greedy. Are people being greedy right now? Let me know in the comments what you think. So first of all, I'm seeing meme stocks all over the place. Dogecoin, right? The CEO of Dogecoin stood up, and he started it as a joke, by the way, but stood up and says, look, we are not an $8 billion company. We're not worth as much as we're being valued at. Wall Street Bets, GameStop and AMC, these pumped up stocks and to the moon stocks that everyone's jumping on are all over the place, right? There's countless YouTubers that have all of a sudden become stock market experts and they've ditched their fidget spinners and now they're promoting brokerage accounts and putting 100% of their savings into crypto and all this crazy stuff. When everyone is talking about stocks, you know there's likely to be a crash. This is called odd lot theory. And there was a quote from Joe Kennedy, who made a lot of money back in the Great Depression. He said, when the shoe shine boys, when the people shining my shoes were talking about stocks, I knew it was a great signal to sell. And I think you can agree that there's plenty of people talking about the stock market right now. Also, right now, from an outsider's point of view, it looks like the most crumbly stocks are doing the best. Yahoo even posted an article on this the other day. And on top of that, there's Pokemon cards selling for thousands and thousands of dollars. A signed Michael Jordan basketball collector's card went for $1.4 million. And then there was another one sold last week for $740,000. What does that say about the recession that we're supposed to be in right now? Fake money? People have stimulus checks, bounce back loans, Sybil's loans. Billions and billions of pounds have been printed out of thin air to prop up the economy. But really, it's a bit like putting a Band-Aid on a shotgun wound. Or you spray some air freshener around a bit, but after a while, that smell of will be back and it will linger. What I'm trying to say here is that it's like we've masked over a real crash by printing money for everyone. Over 30% of the entire history of US money was printed in the last 12 months. That is a massive concern. People have more money to spend. On top of this, interest rates have remained so low for so long, and that's unsustainable. That can't last. So as soon as they raise the interest rates, the tide will go out and we'll see who's been swimming naked. Now, another indicator here is the price to earnings ratio of some of the best performing companies in the world. A price to book ratio and a price to earnings ratio combined can give you a really good indication as to when a company is undervalued or overvalued. And if you've read The Intelligent Investor, you'll know this from the book when Benjamin Graham talks about this formula in the book. And I want you to check some of the price to earnings ratio for some of these companies here. So I've pulled up graphs here on an average 10 years to see what they're trading at, what the trend is here, compared to the average and all-time highs. And this will indicate an inflated price, and we can see if the market is a little bit greedy right now, and if the prices are a little bit too optimistic right now. Now, remember I said some of the worst companies seem to be doing well right now, and people are talking about the crumbling businesses. Well, another sign that when the pandemic hit, lots of small businesses and bricks and mortar businesses struggled massively. So investors pulled their money out of them type of businesses and put it into safe plays like tech companies, social media companies, and digital companies, which explains the delayed inflated earnings report of the overextended PE ratios. But now there's kind of light at the end of the tunnel. Investors are now seeing the overinflated prices on the big players and saying, right, I'm paying too much for that now. I know we saw some of these other companies struggle, but let's face it, people will continue to go to restaurants, people will continue to travel, people will continue to use lending institutions, and they're not going away anytime soon. So even on their bare bones, even though they took a dive bomb, let's put some money there because they're likely to pull through and I can get them cheap. Remember, the market is what people will pay. The question is there any more value left in these tech companies at the moment? Not much. Hence the switch to these cheap recovery stocks. Warren Buffett has just plowed $8 billion into Verizon Communications stock. That says something. Now, often the stocks that most people think that are going to go down end up going up. The problem is with that herd mentality kicking off is the financials and the technicals of stocks are becoming detached from the fundamentals, and it makes little sense. It looks crazy. And from that point on, it's normally a bit of a dogfight, and the dogfight normally ends in a big crash. There's been billion-dollar bailouts to airlines and banks, printing money to everyone. Mortgages are another reason. People getting mortgages with low interest rates, which they think they can make the monthly payments because they're easier to manage because the costs are low, until the rates go up and no one can afford their houses, or they can't even sell their houses. On top of all this, we've got the baby boomers. If you take the US and the UK alone, you've got about 50% there of that population made up of baby boomers, meaning that we're about to see the largest transfer of wealth in history as more people go into retirement than ever before. Richard Branson built his entire empire off the back of the baby boomers. That's how vast it is. He started on student magazines, then he went into music, then he went into banks, then he went into gyms, then he went into airlines, and now into cruise ships, and there's even talk of him going into retirement homes. He literally built his empire by following that entire generation, which made Virgin a fortune. But the point is this latest recession is going to make baby boomers retire. They've been for a few before, and they're probably going to say, I'm not doing this again, I'm old enough now, I'm out. And they'll be using this as their excuse to chuck in the towel and shed their assets. Now, did you know that about 80% of baby boomers are equity millionaires? The average net worth of a baby boomer is $1.2 million. This means that they own a lot of property, and they also own a lot of business. We're about to see an influx of commercial property and residential property come onto the market, which will drop the prices of the property market, raising interest rates. No one will want the property. And when I say nobody, I mean the fearful people. But again, most companies have adapted to remote working. Their millennial grandchildren won't want bricks and mortar property because they want to be free and nimble and travel and work from Starbucks whilst drinking their $5 coffees. There will be bargain basement deals going on in business, selling of businesses for cheap, lots of assets on the market and not many buyers. Enter one of the biggest crashes since the Great Depression. Although we've just seen a 30% crash in 2020, I think we're about to see a 40% plus crash in the next 12 months. And of course, this is all very new. And of course, there is even more talk of more stimulus, more furlough, more loans being thrown in to prop up the failing businesses. But all I can do is go off my educated analysis and probabilities and knowledge in the markets to predict the result of what I'm seeing watching this entire spectacle right now. Another clue is when you hit the like button, something amazing happens. Go on, watch what happens. I'm just kidding, but go on, give it a like. Look at the shape of this last crash, okay? It's too quick a recovery time. We're also trading above the mean growth of the market for the last 52.5 years, which indicates that overall we're inflated. The market's inflated or has some unsustainable optimism, as Benjamin Graham would say. So it's time to keep some powder dry. And although I will always have chips on the table, I'm carefully depositing liquidity into the markets right now and waiting to see if we get that big dip, then I'll be greedy when everyone is fearful so that I come out of the recession in a nice tidy profit. So that's it for this video, guys. Let me know your thoughts, and if you've watched this far, definitely give it a like and put a comment below because I love reading the comments down there. And in the words of Benjamin Graham, the market is a pendulum that swings between unsustainable optimism and unjustified pessimism. An intelligent investor is a realist who buys from pessimists and sells to optimists. One of the greatest quotes of all time. Take care, guys, and I'll see you in the next one.